In this video, we're going to talk about how to do technical analysis in crypto. If you're looking to learn how to master technical analysis, I'm going to do my best to explain things in a really simple, easy to understand manner that literally anybody can get. By the end of this video, you'll understand what are candlesticks and what are the most important candlestick patterns and how to read them. You'll also learn how to mark up your charts or how to draw certain things on the charts that'll help you make better decisions. You also learn some of the most popular chart patterns that have the highest edge. And also we're going to be talking about some of the most popular indicators and how to actually use them. And the reality is that most people get technical analysis completely wrong. They use indicators wrong. They use chart patterns and candlestick patterns wrong. And in this video, I'm going to show you the right way to do this. Okay, so first things first, let's actually take a look at candlesticks. So candlesticks are shown on these charts, as you can see here, and generally they're referred to as Japanese candlesticks. This was a way that the Japanese invented to be able to better understand what's actually happening with price. Now, each one of these candlesticks represents what's happened with the price of a certain asset during a certain time period. So here you can see I have it on the daily time frame. This means that every single one of these candlesticks represents one day. If I were to change this down here to the 1 hour time frame, now each one of these candlesticks represents 1 hour. And I can even change this down to the 1 minute time frame, where now each one of these candlesticks represents 1 minute. So to better understand candlesticks, let's actually take a look at this. So candlesticks are made up of this green or this red portion here, which is called the body. And it also has these two longer wicks. They're called the wicks of the candle. And essentially on a bullish candle or a green candle, this bottom part of the body is where the session actually opened at. So at the beginning of the day or the beginning of the hour or whatever time frame you're trading, this is where price was at. Now at the close of the session, this is where the price was at. Now, also you have the low of the range and the high of the range. This means that during this hour time period or this hour-long session, the price had gone as low as it did here and it went as high as it did here, but it ultimately closed right here. Now, if we look at a bearish candle, for example, the red candles, this basically means that the open price happened right here. The session opened at this price, the session closed at this price, forming the body. And then it went as high as it did here in the session, and it went as low as it did in the session here. So now that you understand how a candlestick actually works, let's talk about my 4 favorite candlestick patterns that help you give an idea of where the market could be heading. The first one is called an engulfing pattern. And basically what that means is the body completely engulfs the body of the previous candle. So you see here we had a bearish candle, and now we have a bullish engulfing candle. It's engulfing because the body completely engulfs the body of this previous candle. Now, generally what happens when we get a bullish engulfing candle, this is likely a sign that price is going to continue to move upwards. Now, on the other side, we could get a bearish engulfing candle where this red bodied candle completely engulfs the body of this previous candle. And this is also a sign that we could be going lower. So let's take a look at these and find these on the chart. Okay, so here on the Bitcoin daily chart, we saw an example of a bullish engulfing candle. This green candle completely engulfed the previous red candle. And as you can see, price moved on upwards. And here we can see the example of a bearish engulfing candle right here, which completely engulfs the body of this green candle here. And as you can see, price continues to move downward. Now, obviously this doesn't happen 100% of the time, but it does have some sort of an edge. The next type of candlestick that I like to talk about is something called a pin bar, or also sometimes referred to as a kangaroo tail, but it generally has this small body and it has a small wick, and then it has this really long wick, which is like a tail. Or you can see it here, another example, generally a small little body. It has a small wick generally, and then it has this long wick, which basically means in this scenario that buyers tried to win and price went all the way up to here, but ultimately they settled all the way back down here. So let's go take a look and actually find some examples of some pin bar or kangaroo tails. Okay, so right here we can see the example of a bearish pin bar. We see this small little wick here, we see a small body, and we have this long tail. And essentially what this means psychologically is that buyers tried to step in and they got as high as here, but they ended up closing all the way down here. So this is generally like a signal that there could be a reversal happening in the market. And as you can see here, we got all these long wicks and boom, price fell. Okay, and here we can see it in the bullish direction. We can see we actually got two pin bars back to back. So you can see here, it had this small wick here, had this body here, small body, and had this long tail. Same thing here, had a small wick, had the body, and had this long tail. So it's basically saying that sellers tried to push the thing all the way down to here, but they ended up settling up around here. And we saw two of these in a row, which is even a stronger signal that price could be reversing, and we saw it reverse here. And the last pattern that I really like are something called tweezers. There's tweezer bottoms, which generally is a reversal pattern at the bottom, and meaning that price is going to move upwards. And there's tweezer tops, which basically means that this is likely a reversal pattern coming on to the downside. And the way that you can think of this is it just looks like tweezers. They have similar size bodies and they have similar size wicks down to the downside. So they're both wicking in here. And then you can see it to the, you can see the tweezer tops here as well. Similar size bodies, similar size wicks, and we see a reversal pattern. I think this is a really powerful reversal pattern as well. Here's an example of a tweezer top. It's not exactly the same body length, but you can see that both of the wicks have gone about the same. And you can see that, this body's a little bit bigger, but this is an even more powerful tweezer top because this body's a little bit bigger. And as you can see, price fell down after this. And the psychology behind this is basically that buyers are trying to push the price up here, but they're not able to successfully. And this is generally a reversal type pattern. Here's another example of what could be a tweezer bottom. You can see that the body lengths aren't exactly the same, and you don't find them exactly the same often, but you can see these wicks are about exactly the same, meaning that they tried to push down here to this price here, and price ended up reversing all the way up. So the tweezer bottoms and tweezer tops are really powerful signals. You want to look for these wicks to be about the same. Now, those are some of the most popular candlestick patterns and how to actually read them and use them. But candlestick patterns alone are not enough to give you a significant edge or trading decision. Likely with technical analysis, what you want to do is combine candlesticks with some of the other tools that we're going to talk about in the video right now. You could combine these candlestick patterns with different chart patterns or different trend lines or support and resistance, or you could also combine it with different indicators, which we'll talk about later on, and we'll tie it all together. Okay, so the next thing that we want to talk about is we want to talk about drawings, and we're actually going to talk about trend lines. And trend lines are basically essentially this, okay? You can see that this is a trend line right here, maybe not exactly perfect, but you can see that we came in here and we hit this line and we bounced off. We kind of bounced off here, we bounced off here again, and we bounced off here again. And so basically a trend line can help you identify a trend, obviously. And you can see that the way that you should trade a trend line is once you see that you're in a trend, which basically means you get 2 or so bounces off of, well, then you can come and you could say, okay, once you get a bounce off the trend line, I may want to take a long trade. And once you see that this trend line has been broken, which you see that it's been broken right here, generally this is a sign that the trend could be ending and you may want to start to look for short positions, as you can see would have been beneficial right here. And here you can see another example of a trend line. You can see that actually this trend line even kind of extends all the way up to here. But you can see we had bounce here, we had a bounce off the trend line here, we had a bounce off the trend line here, a bounce off the trend line here. So ideally, you'd want to be looking to take short positions once you get a bounce off of the trend line. And as you can see, the trend was broken momentarily here, and you can see that the market started to kind of move up a little bit, but ultimately ended up falling back down. Now, the next drawing that I think is maybe the most important drawing is learning how to draw support and resistance. And all that means is support is something that acts as like a floor, and resistance is something that acts as like a ceiling. So let's take a look at this. Now, I'll give you a little trick. The best way to draw support and resistance is to actually come over here and to draw it with a line chart. And essentially what you're looking for is you're looking for a line where the price has touched multiple times in the past. So for example, we can see that it touched price twice here, then it touched it again, and then it's touched it a lot right here, right? And this happens to be right at $30,000. And generally you'll notice that round numbers happen to be key support and resistance levels a lot of the time. So you can see that we bounce off 30,000, we bounce off 30,000, we bounce off 30,000, and then we really bounce off 30,000 quite a bit of time. And this is how you want to draw support and resistance lines. Now, if we take a look at another place where we had many bounces, we had a bounce here, we had a bounce here, we had a bounce here, 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 we had several touches throughout here, several touches throughout here, and this happens to be $40,000. So this was also a key level. Now I can see this actually drawn up nicer on a candlestick chart pattern, not a line chart pattern. And what I could see here was if we take a couple things that we've learned so far, I can see this was a key area of support. So I know that price is likely to bounce off it. I can also see that I got this bullish engulfing candle right here. And what do you know? Price continues to move upwards. So just to recap here, you can see how basically this $30,000 mark has acted as a support or as a floor a lot of the times. And you can see these long wicks that are wicking in here to the $30,000 mark. So price is trying to test it, trying to test it, trying to test it, trying again. And then finally we get a bounce off, right? Now, the interesting thing is a lot of the times once a support zone, and this would be resistance to the upside, right? We tried to break it here. We tried to break it here, tried to break it here, and it kind of got stuck. And then finally we broke through it. Now, a lot of the times we'll notice that these resistance lines can become support. So we saw that price continued to move upward here. And then what happened? This was a previous resistance, and now it turned into a support or to a floor, which we got a nice bounce off and a breakthrough. Now, the general rule of thumb is you generally want to make trading decisions at key support and resistance levels, because these are levels that price is either going to bounce off of, or it's a level that price is going to break through. And these are key levels that you can see easily on your chart if you do use the line chart like I showed you. So the next thing that we're going to take a look at is take a look at chart patterns. And we're going to take a look at just a couple of the most popular chart patterns. So the first one is a double top and a double bottom. And essentially what this is it's basically saying on a double bottom, it looks like a W, and a double top, it looks like an M. So just try to find W's and M's in the chart when you're looking. And basically what it says is that sellers tried to push it down to here and they got rejected, and they came back up. And sellers tried to push it down again here again, and they got rejected right here. Now, this line right here, where basically they bounce to, is something called the neckline. And the way that you want to trade this is after you get a break of this neckline, then it's likely that price is going to continue on upwards for a double bottom, and the exact opposite for a double top. This essentially means that buyers tried to get here and they got rejected from the sellers, right? And then they tried to buy up to here again, the exact same point, and they got rejected. And once you break the neckline, then this is where you want to start to look to enter a trade. This is a really classic, easy to spot pattern, double tops and double bottoms. Okay, so let's try to find a couple of these. You can kind of see one right here, a double top. We had the first mountain peak, then we dropped down to here, and then we had the second mountain peak, and then we started dropping. And then once we broke the neckline, which was like this area here, you can see price continue to fall on back downwards. So it's not perfect, but it's pretty close. You can see it's a clear like M-like pattern right here. And here we can see it to the reverse. We can see that we tried to come down here, we got stuck, we went back up to here, we came back up to here again, and then boom, once we broke this neckline, we continued on upwards. And so this would be an example of what's called like a double bottom or a W. So as you can see here, this is an example of like a volatility compression pattern. Basically, the volatility starts to get compressed and compressed into this tight little range. And the way that the market works is the market moves from like breakouts to volatility compression, to breakouts to volatility compression, to breakouts to volatility compression. And as you can see here, after this volatility compression pattern, we saw a price break out onto the downside. And then what do we see that's starting to happen? Again, we see that we're getting some sort of volatility compression pattern right here. And what will happen after this pattern is we'll get some sort of breakout. We can also see examples of volatility compression patterns in the form of triangles. And basically the way that this works is we can see that the volatility of it starts to compress into this tight little triangle range, and then we get a breakout. And you can see this happening kind of all over the place. If we take a look at it here, we can see another volatility compression pattern right here, where basically the volatility starts to compress and get tighter and tighter into this little range, and then boom, we get a breakout. And so I think these are two of the most important chart patterns that you could spot is double tops and double bottoms. They're easy to see. Sometimes you can even have triple tops and triple bottoms, by the way, and they're even more powerful. And then you want to look for volatility compression pattern. Once price gets really boring and it starts getting into this compressed range, we know that a breakout is likely to happen next. So now that we've talked about candlesticks, we've talked about support and resistance and drawings, we've talked about popular chart patterns, let's take a look at some of the most popular indicators and then we could put it all together. Okay, so the first most popular indicator by far is something called a moving average. And you can just go here and you can put it on your chart, and it's this blue line right here essentially. And if I click on this blue line, I can change the settings of it to right here. So I can say, for example, I want to use like the 50 moving average like this. You're going to see that the line is going to get smoother. And basically what this does is it takes a look at the 50 last candles and it will plot it on a line like this. So this is taking into account this plot right here. What was the price of the 50 previous candles? And it'll plot it right here as an average for us. And the way that you can use this is you can use this to help identify trends. So generally, when the candles are below this moving average, generally we're in a downtrend. And if you look at it on the opposite side, if the candlesticks are above the moving average, then we're in an uptrend. And a lot of people will just trade this simply that once the candlesticks cross under the moving average, they'll take a sell position. And then once it crosses above again, then they'll take a buy position, because this is usually an indication that we're in an upward trend. Now, one other thing that you can do is you can actually put on two moving averages. So you can see that I've now put on two moving averages, and I'm just going to change this. Let's say, for example, I want to make this like an 8 moving average, for example. So now I have two lines, and I can actually just change this fast one here, and I'll change the color to something else. And now I have the fast one as yellow, and I have the longer one as 50. And so another way that you can trade this is just when the lines cross, you can trade it. So for example, you get a crossing of the lines here. This is generally the indication that the trend has changed, and we can see it's crossed down here. Okay, now again, we see that the cross happens here and we get a downward trend just like we're seeing here. So these are moving averages. There's a couple ways to trade them. You can use two, you can use three in conjunction, or you can just use one of them. And this will give you an idea of what's happening. And this is a really easy way to get an idea of what's happening with the trend. And a lot of the times, a lot of people will use these moving averages as like trend lines as well. So as it gets close to the line, then you could take a sell, right? The next indicator that we're going to look at is something called the relative strength indicator. And this is probably the second most popular indicator. And this is actually what's known as an oscillator. And basically what that means is that this indicator is going to oscillate between like 0 and 100. And this is going to talk about what the relative strength is in the market. So this is what's known as a momentum indicator. And there's a couple ways that you could trade it, but generally, once this crosses above 70, this is what's known as overbought, meaning that maybe this asset has been overbought and maybe it's going to run out of steam, which you can see here, it got really overbought. It came all the way up to 78. And as you can see here, this was close to the top of this market. And then we saw it roll back down over. And we can also see it working in the other direction. So once it goes below 30, this is generally what's called being oversold, meaning it's too far sold, right? And this came all the way down to like 15. And this marked like the bottom here at like $4,800 for Bitcoin. And we can see that price continued to move upwards. And the last indicator that I'll show you is something called the Bollinger Bands. Okay, so I can just go ahead and put on the Bollinger Bands, and you see it brings me this nice little range or this channel. And basically what this is, this middle line is like a moving average, okay? And then these two blue lines are basically two standard deviations away, meaning that like 90 to 95% of the price action is going to fall within these blue lines or these blue channels. And so a really simple way to trade it is basically when it hits the lower line of this blue channel. This is generally when you want to take a buy because 90 or so percent of the volatility happens within inside of this range. And then when it comes back up and it hits the upper band, then this is usually when you want to like get out of the trade. Or you could also trade it. You don't get out of the trade until it comes back down to this orange like midline or this orange moving average line. And Bollinger Bands are also good to trade both in trending markets as well as ranging markets. As you can see here to the upside, we saw that we came up here and we kind of hit the top of this blue channel. And then we saw that it came back and it traded all the way back to this other channel here. So one way that you can trade it is simply, selling it when it hits the upper band and then buying it when it hits the lower band. Now, obviously, this is a very simplified strategy, but if you use this in conjunction with other things that we've talked about, like candlestick patterns, and you use it in things like candlestick patterns, like for example, you can see right here, we kind of have like a tweezer bottom, right? We also knew that this was the lower band. So maybe this was a good indication that, hey, maybe I should get into a trade here. And you can see that it continued upwards. So in conclusion, technical analysis is something that will allow you to gain an edge in your trading, and technical analysis is not everything, right? It doesn't always play out, but it does have some sort of slight edge. And that's all we're looking for in the markets, is to have some sort of slight edge in our trading. And as a general rule of thumb, the more confirmations that you can stack on top of each other, for example, we have a support range. We see that we're also, at the lower channel of a Bollinger Band. Also, if we had the RSI and we had some sort of candlestick pattern, then this may be a trade that's a higher likelihood setup than something like you just see one candlestick pattern. So with that being said, I hope this video is helpful. Go ahead and like, subscribe, and turn on the post notifications if it was, and feel free to check out some of our other videos on this channel.